More stock ideas? Yes. This time we're going all in Canadians. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero, and today we put our moose on our head and we are in for an all-in Canadian stocks to buy for 2025. How are you doing, Vero?
Good, and you know what, Mike? Talking about Canada, how's your run doing in the winter snow?
I kind of like saw it coming so much. I mean, really, I'm very close to just sell my house and move elsewhere. Literally. I mean, the wind's on my face. There's like snow every single day. I'm not a winter person. I don't like it. I still run though. I still run. But I mean, what's so much fun about running when it's minus 25 and there's like wind in your face? I'm not too sure. But at least I hope that I'm like burning more calories. So at least it's going to be like it's going to show at the end of winter. But anyways, yeah, that's how my winter is going. Like now you get me hangry.
No. It's not gonna last because we have a good episode ahead, so it should be great. Okay. So today I'm gonna like continue because I don't want you to get even more upset. So today we continue our stocks to buy mini series with our top 3 Canadians and their industry. Are you excited to see which ones I selected for you, Mike?
Yeah, actually, I think that we're going to talk about only one that I hold, one big regret, and the
Mhm.
last one, a company that we don't talk enough.
Great. So, a quick reminder before we start, you should not consider the stocks mentioned in this episode as buy or sell recommendations. You must always proceed with your due diligence before any transaction. Mike, we start this week's episode strong with a stock part of the energy sector, specifically in the oil and gas exploration and production. That is a lot of words here, so please explain this industry to us.
So I'll even go one step further and cover the three major segments of the oil and gas industry. So exploration and production is part of the upstream segment. So those are companies that are drilling, pumping, like exploring, trying to find either natural gas or oil. Then you have
Mhm.
the midstream. So the midstream is all about storing those resources so you can and transporting them. So you can think of like pipelines. Those are usually the one that we discuss on the podcast and even at DSR because they're less dependent on the oil price. Same thing
Mhm.
with the natural gas. So then you can count companies like Pembina, TC Energy with their spinoff Salbo, and also Enbridge. So generous yielder. Like small dividend increases, but usually enough to keep up with the inflation. So the type of company that could be seen as the Luke's bond, a good stabilizer, and of course, very much loved by income seeking investors. And then you have like the downstreamers. So downstream is all about refining and making products with the oil or with natural gas. For this one, we look at the upstream, so exploration and production, that is usually not necessarily a a segment that I appreciate, to be honest, not because it's a bad place to start investing, but mostly because those companies' business model are heavily relying on oil price and natural gas price. So when the commodity price are going up, they're making a ton of money. When it's going down, they usually get in debt, slash their dividend, and then their stock price tumbles. So a lot of volatility since I prefer to pick companies that are able to increase their dividend every year.
Mhm.
Not great candidate in general, but there are some exceptions.
So, should it be an industry that performs well in 2025, or will it be difficult?
Well, actually, you never know. And here's the thing. If you look at like oil bulls, they're going to tell you that the oil barrel is going to reach 100 and 150 and then $200 every single year. Ironically, I've read like papers back in 2010 telling me exactly the same thing. 15 years later, we still are not showing an oil barrel at $200. But yet, maybe it's going to happen. And that's the beauty of it. You never know. If the economy is rolling, and there's a heavy demand for commodities, well, of course, natural gas and oil is going to ramp up, and then the best place to be is in the exploration and production segment because they're going to make a ton of money. As of late, the oil barrel and natural gas price have been relatively quiet, actually more on the down cycle over the past 2 years. So not necessarily right now a place where those companies are generating like revenue or cash flow growth, but it's either
Mhm.
stable or slightly going down, but it's normal. It's super cyclical.
So the company to discuss is Canadian Natural Resources, CNQ.TO, also trading in the US as CNQ. How would you describe this business?
So this one is probably one of the best oil and gas company. Of course, it's not just about upstream; they also have pipelines. So I'm we are cheating a little bit here. It's not a pure play on exploration and production, but that's actually what I love about this one, and
Mhm.
that what enabled CNQ to keep on increasing its dividend for several decades, which is quite rare in this industry. They own high quality assets, which enables them to be profitable even if the oil barrel would go down at $40, which is also quite rare. And what they do is that they manage their production accordingly. So
Mhm.
whenever the commodity prices are rising, they are ramping up production, generating tons of cash flow. And when it's the opposite, they're just slowing down their production and they're just waiting for the next cycle. Since it goes with waves like this, it's not easy, but I mean, for a company like this, they know what they're doing. They have like great expertise, so they are able to do that. One thing that has been remarkable for CNQ is its way of managing their cash flow throughout cycles. So their capital allocation is very, very good. Whenever, like as of late, they have paid down their debt to a specific target of 10 billion. So they use extra cash flow to first pay down debts. Then they started to buy back shares and increase their dividend with a generous increase, like double digit over the past 5 years, which pleased a lot of investors.
And what are the reasons to buy it in 2025?
Well, the stock price has not done much over the past year and a half, 2 years. It's still a very stable dividend grower. And when you're thinking about the Canadian market going up like 20% last year, well, CNQ was not part of the party. It did well, but not as well as the market. So lagging a little bit
Mhm.
behind. It's usually a good place to start shopping around and buy some stocks. I think it's a good time to get a company offering you a very decent yield actually with some dividend growth perspective. And who knows if we have an upcycle commodity price that is coming up, well, CNQ will definitely ride this wave.
And why would some investors be tempted to avoid it?
Well, actually, investors are sometimes surprised by CNQ's volatility because, as I described, the company is profitable regardless of what's going on with commodity prices. But if you see the oil price going down by $3 on a single day, you can be assured that CNQ stock price will also be down.
Mhm.
So it's kind of like a stable business, but a volatile stock, if I can put it that way. Sometimes there will be underperformance for a long period of time. So also you have to be careful with that. If you they recently split their stock, but if you go with price adjusted split, do you know what was the price around 2010?
No.
So it was around $20. And do you know what was the stock price around 2020 right before COVID hit?
No.
Still, still again $20. So for about 10 years, the stock price, yes, went up and down throughout that period, but literally did not do much. So besides an increasing dividend, you did not get a lot out of that investment
Mhm.
for 10 years. So you have to consider this. I see CNQ more like kind of like a deluxe bond. I like to use this expression for a company where I don't expect too much for the stock price. So like maybe the stock price will increase, but I buy it a lot more as a company that will fluctuate a little bit, but in the end, not necessarily going to generate a huge capital gain, but will pay me a very good dividend, and it will increase enough to beat inflation. Actually, CNQ is increasing it way more than inflation and
Mhm.
shows decades of consecutive dividend increases. So that's enough for me to say that this one is a pretty stable business, even if you have to deal with a shaky stock price from time to time.
Okay, so let's move to the utility sector. The company I'd like you to present is part of the regulated electric subsector. What makes it interesting?
So, utility sector in general last year did well. A part of it was renewable, actually. That is not what we're
Mhm.
going to talk again today, but I just wanted to highlight that ironically, this time it was not necessarily because like investors wanted to invest in renewable energy, but more like tech stocks are looking for renewable energy sources to power their AI center. So it demands a lot of energy, and the best way to do it
Mhm.
is probably to go with renewable. So we have seen a lot of deals being inked by companies like Microsoft, for example, with a deal with Brookfield Renewable for 10 billion. So there's a little bit more of enthusiasm on that part. On the regulated side, what is great is the stability. I mean, it's super boring, and this is why I mentioned at the beginning of this episode that we don't necessarily talk enough about some of those companies because they are kind of like the foundation of your house. You don't really think about it. And if there's
Right.
nothing broken there, you don't go downstairs to see if it needs to be fixed. And with lower interest rates, we're going to see more income seeking investors probably going back to utilities. Actually, one of them was Capital Power that was up more than 70%, if I remember, in 2024. One of like the best performing dividend stocks out there. Kind of ironic, but sometimes it happens. So for investors thinking about 2025, I think the best advantage of this sector is definitely the stability and predictable cash flow.
So, according to this year's main investment themes, should it be an industry to thrive?
Well, actually, it's not supposed to be thriving. Like not today, not ever, in a sense where we have like very stable business here, and sometimes investors they look at a few years where the market was on fire, and of course, when the market is on fire, all sectors are doing great. So utilities was part of that, and then they're kind of like surprised, how come my utility stocks are not growing double digit? Well, they're not really supposed to be. It's
Right.
it's it's a great sector, but it's a sector for stability and predictable
Mhm.
cash flow, not a sector to go face to face with tech stocks that are growing like 15% per annum, right? So
Mhm.
it's a great place for income seeking investors as well. And we're really looking at companies that are dealing with regulators every year. So they are used to that regulator process to increase the like to fill out the demand to increase the rate, negotiate with regulators, and then get like a rate increase to make more money. It's a kind of like again long like boring process, but that works, and that works very well because you can buy those kind of companies, put them in your portfolio, and you can afford to forget about those from time to time.
Mhm. Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. So without further delay, tell us more about Hydro One H.to.
So Hydro One, a company that we rarely talk about, but this is probably one of like the most interesting regulated utilities in Canada. The
Mhm.
company operates over 30,000 kilometers of electric transmission lines in Ontario. They own about 30 billion in assets, and they are owned about half, so 47% of their shares are owned by the government of Ontario.
And why does it deserve a spot in your top stocks for the year?
So Hydro One shows a very solid dividend triangle. At first, I was like, yeah, let's give it a few years before we
Hmm.
see how it shapes. And clearly, the company did not disappoint. It's growing on a steady basis. They use the classic playbook for all regulated utilities. They have their capex plan year over year. They like at this point they expect to invest between 1.3 and 1.6 billion throughout 2027. And then what they do is that they go see the regulators and then they say, well, how about we increase our rate a little bit? So they expect an earnings per share growth of like 4 to 7% during that period and a dividend growth rate of 5%. So when I'm talking about like a stable relationship between the earnings, the dividend, the stock price, you have everything there at Hydro One.
On the other hand, what are its potential risks?
Well, they are operating in Ontario, so they are limited to that growth. I mean, population growth, economic growth. That's pretty much how they're going to be able to expand their business. They
Hmm.
could try to make acquisition, but then we're going to enter into other kind of risk. They can be. I know that they try to make acquisition in the past. Sometimes it's not necessarily getting approved by regulators either. Of course, interest rate, I don't think it's going to be an issue in 25, especially with all the interest rate cuts that we got in 2024. But they still have to manage interest charges because they're capital intensive. So whenever maybe in a year or 2 years from now we're going to go back to higher interest rates, well then they're going to face that. And also like political pressure, I would say, because the government of Ontario is not too far behind, so they could try to apply a bit more pressure on management and try to get inside of like what Hydro One should be doing or not. A little bit of like what we see with Hydro Quebec, that is 100% owned by the government in our province. While now at 47% stake, I guess the government of Ontario has a word or two to say to the CEO.
Hmm. So, last but surely not least, the next idea is in the consumer discretionary sector and part of the retail industry. What are the key points about this subsector?
Well, this one is quite cyclical, right? I mean, we all depend on the economy, all depend on the consumers, and we have heard about like many CEO, like one that I've been following for a while, and we're not going to talk about Canadian Tire today, but Canadian Tire CEO have been talking about consumer getting struck with their budget in Canada for like at least a good year, like 4 quarters
Right.
in a row easily.
Hmm.
So all the extra spending not happening, very tough. But I mean, I've been expecting a recession for a while in Canada. It's not happening, so who knows? But this one is really, it's going to go well when the consumers is having a job and spending a lot and being confident in the economy. Right now, with the unemployment rate around 7%, not too sure it's going to happen short term.
So, Mike, I guess that it should be an industry that does well this year, right?
Of course. Well, that's the thing. I mean, again, it is probably the best time to look at this industry, though, to pick some shares of an interesting company
Hmm.
on your buy list. Maybe you want to wait a little to see if we are getting into a recession, because then, of course, upon those kind of news, we'll have stock price going to drop a little bit more. So that could be a good entry point in that sector, definitely in 2025.
So, we both wish we had it in our portfolio. Dollarama, DOL.TO, was actually on my buy list last year, but I thought I had enough exposure to this sector. So, what makes its business model attractive?
Yeah, Dollarama. I mean, I just want to take a moment to talk about a sector nomenclature for a second because I know it's
Hmm.
going to confuse a few investors, and I'm totally on board with you. We could see Dollarama as a consumer staple, as a discount store, and I would not argue with that. However, when you look in Y charts, when you look at Seeking Alpha, when you look at Refinitiv, owned by London Stock Exchange, they all say it's discretionary. So, I mean, you
Hmm.
might want to buy, you want my to call Seeking Alpha or the London Stock Exchange to tell them that they're wrong, but I'm not the one who's making rules here. So let's say that Dolorama is a consumer stocks, and let's put the rest of it a little bit blurry around it. When we talk about sectors, the important point is to understand the business model that you're going to add to your portfolio, and understand how it's going to evolve depending on the market events that are going to happen in the economic event. So usually when we say, oh, don't be overexposed into one sector, it's more a red flag. That doesn't necessarily mean that you must sell half of your sector if you're at 30% in a specific industry or something, but more like, oh, there's a red flag. I should probably look to see if I have many companies with the same business model. Because if
Mhm.
it's the case, well, then you're just overexposed to the same business model and you're not adding diversification. Um, or on the other side, if you have Dollarama, but you have like other companies in other sub industries, then it's not the end of the world. So just to make that clear. Now, going back to Dollarama, I mean, it's kind of like the new version of a general store. So
Right.
cheap stuff, most of it under $5. They own a big part of Dollar City as well, with the same playbook in Central America. They have two ways of growing, which is interesting. Their motto is to open new stores, and so far it has been doing well. So they are growing in Canada, they're growing in Central America by opening many, many stores every year. But the thing that I found more interesting, though, is to follow their comparable sales stores. So, comparable sales stores is when you look at the stores last year versus the same store this year, and they are able to attract either more consumers or make them spend more money inside their stores. So they're growing their sales both organically into by convincing more people to buy more stuff, or by opening new stores.
And why should we buy it now?
Because the company's on fire, literally. I mean, they show an amazing dividend triangle. It's been 10 years now that revenues are growing constantly, earnings are following. So they have like, ironically, good pricing power and the ability to maintain their margin, even if they're trying to sell stuff as a cheapest level possible. And of course, even though it pays a very low yield, it keeps increasing its dividend generously. Um, the growth seems to not slow down. And on top of that, when you're thinking about that, right now, they have benefited from a higher inflation because people are trying to save a few bucks. So they're going to Dollarama for a lot of like more purchases than they were before. And my
Mhm.
guess is that they will be quite recession resistant. As again, if consumers has less money to spend, while the little money that they will spend, they will be trying to find deals and buy cheaper stuff. So Dollarama will still be a number one destination for that.
And just as anecdote, because I mean, my experience is not necessarily that relevant, but still, during the holidays, I went shopping to both Canadian Tire and Dollarama. Dollarama was full of people, and Canadian Tire was empty, and I was even surprised by that. So, just like on a side note.
So your husband must have been very, very disappointed.
Yes, because he loves Canadian Tire. But anyway, we still keep on going, but it's just other people that don't.
Hold the fort for us.
So, Mike, are there any downsides to be aware of for Dollarama?
Well, the main reason why I never pulled the trigger on this one and never added it to my portfolio was because I thought their growth was limited. Obviously, I've been wrong. So that's the story. But I'm just thinking, they're growing in Canada. They have like a very strong brand there, but they
Mhm.
don't grow in the US. So I
Right.
mean, they're not even present in the US. And honestly, I think it would be a mistake because it would be quite costly. There's a lot more competition over there, so they're kind of like limited to our country. I like the acquisition of the stakes into Dollar City. Could be more volatile down the road, but again, I thought, is there like enough room to keep on opening new stores? Well, apparently there is, but I was quite surprised. Overall, there is still a lot of competition though, because the more you open stores, the more you're gonna get closer to a Walmart or to another
Mhm.
like bigger chain, or you're just going to face a saturated market. I mean, where I live, we cannot have like 10 Dollaramas, so at one
Mhm.
point you have to make choices also to and you're going to be limited to how population is growing. With the immigration is slowing down in Canada, not too sure it's going to be interesting down the road. Another downside would be to look at what happened with Dollar General in the US. They ran into lots of margin problems. They like their margin that got out of control with a lot of pressure by competitors and managing inventory, and they eventually saw their earnings like going down like very, very fast. I don't think it's going to happen with Dollarama because they have their own brands, and they have showed that they are able to maintain and actually expand their margin for a long while. But just keeping that in mind, to making sure that they still get those margins under control at all cost.
Mike, I'm tempted to ask you for a bonus. Is there any idea we haven't mentioned yet that remains one of your top favorites?
I have to go with this one, but I have to talk about Kushtar for a second. And I know,
I knew it.
it's crazy. Yeah, of course, you opened the door. I'm gonna take it. More seriously, I mean, it was a bad year in 24 for Kushtar, which makes it even more attractive right now. Last time I highlighted it this way was when they failed buying Carrefour in 2021, and that appeared to be a very good timing to buy the stock. So I'm not saying it's going to be the same thing this time, but I'm just saying while the rest of the market is up, this one is stagnating, which is terrible for Couche-Tard. But it's not the first time it happens, actually. The company, while it's recession resistant, shows moments where the revenue and the earnings are not growing that fast. It's kind of like a
Mhm.
pause between like a well executed plan, and now they're trying to adapt to the new reality. So right now, consumers are not necessarily ready to pay for convenience. They are willing to drive the extra mile and go to the grocery stores or go to Dollarama to buy their stuff instead of like just going at the around the corner and buy it from Kushtar. They are facing some economic pressure over there. There was a lot of drama around the potential acquisition of 7-Eleven. Doesn't seem that it's going to happen. So there's not much hype right now, and this is probably what I like about Kushtar at this point is investors are kind of like, I'm not going to give you any more of my love right now. I'm not going to buy that shares because you're not going anywhere. And it's usually the moment where they surprise us. So I'm going to hold on to my shares right now. Very happy with it. And I think that 2025 could be a good timing to buy even more. But on my side, I'm not, because it's already my second largest position in my portfolio. So I'm still going to be on the sideline on this one, and still just going to watch it, hopefully going back strong.
All right, so last week I told you we would give you like 12 stock ideas, but now you are up to 13, right? So
It's
to get
almost half of
six,
the booklet, right?
right. So to get six more stock ideas, download our top stocks for 2025 booklet now at thedividendguyblog.com/top stocks. So thank you, Mike, for pulling out these excellent dividend growth stock ideas. Listeners, if you enjoy what we do, hit the subscribe button now and leave us a 5-star rating. Remember also to download your free booklet at thedividendguyblog.com/topstocks. For the show notes and related content, hit thedividendguyblog.com/211. Until next week,
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.